The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
So many folks were very concerned about expanded broker rules for crypto companies when the Senate passed an infrastructure bill that is now pending in the House. But our next guest warns there is another provision less talked about that could have consequences for the industry, namely requiring extensive reporting requirements on personal information for transfers over $10,000. Failure to comply could result in up to 5 years in prison. And joining us now to discuss is Abraham Sutherland, former Deputy Associate Counsel during the George W. Bush administration and Director of Energy Developer Saker Group. Welcome, Abraham. So, the Proof of Stake Alliance has come out with a report detailing the details of this little-known, little-talked-about provision. Tell us a bit about it.
Yeah, as you mentioned, the most important thing, this is not the broker provision. This is a separate law that creates a new felony, and it involves the reporting of transactions that is not limited to brokers. In fact, it applies to any business, which can include individuals who receive $10,000 or more in digital assets and must immediately report tax ID, social security number information, and other details to the IRS right now within 15 days. And a violation of that reporting requirement, unlike most other or all other reporting requirements, is not just a misdemeanor, but it can be a felony carrying a 5 years in prison.
So can you tell us a little bit of the backstory? Like, how did this even get into the infrastructure bill? Was it just an oversight, or was it people not understanding technology, or was it some sort of intentional blow to the crypto industry?
Yeah, the key here is, and why it's escaped attention. This uses a very old law, almost 40-year-old law, that applies to a specific type of transaction involving physical cash. And under the old law, it is presumed that the payer and the recipient of physical cash are in the same place, and there's a physical transfer of the funds from one to the other. The actual amendment to 26 U.S.C. 6050I is only several words in length, and what it does is it simply adds digital assets to the definition of cash that might require reporting. But this old law is so different. It just does not fit with digital assets. It makes the consequences a little harder to see, which is the purpose of this report that's just come out from the Proof of Stake Alliance, trying to bring attention to these different elements that come into play, which just do not fit with digital assets.
Can you tell us a little bit about what it would take to actually change this? Because, you have sort of the crypto lobby and you have the crypto industry, but, what are the chances of actually making some sort of amendment or getting this out of the bill? I mean, what would it take how likely is it to actually change?
I don't even want to go too far into what it would take to change it, but definitely the first step is to get some understanding of what's going on. Certainly Congress, in creating a new felony like this, should have been more transparent with the consequences and explaining it so that this doesn't come as such a surprise. The creation of a new felony like this should not be taken lightly. But the next step is certainly for people who understand it and are in the industry to understand its consequences and just to raise it. And that's why I think it's critical for anyone involved with Bitcoin, involved with cryptocurrency, to look at this. If you've got a policy person on your team, a lawyer on your team, take a look at the report, pull up the statute, and say, wow, how might this apply to us? And it's only then that we can kind of reveal the consequences, the practical consequences, and how far-reaching its effects will be.
And how does this provision differ, or is it the same as current cash currency transaction report requirements?
Well, technically, it is the same. This is the 1984 law that says that if you receive $10,000 in cash in the course of your trade or business, you have to file a special report. And the steps are important here. If you receive that $10,000 or more in cash, you need to verify and inspect the IDs of the person handing you the funds, and you need to fill out IRS Form 8300. It's a long form. I encourage people to look at it. That's the current form in place for this provision. And so the statute very much relies on this old procedure.
So are you saying that the general crypto market itself doesn't have a handle on what this provision calls for? And if so, why do you think that's the case? And why aren't people making a bigger deal than you think they should? And also, what could be done to change that?
Well, I think they will if they look at it, and I think this report is the first step. But also just pulling up the statute. Again, there was no explanation. This was, as people know, these provisions were put into an infrastructure spending bill as provisions justified for their help in paying for the price tag here. And the fact that this creates a new felony certainly wasn't part of the discussion, and there was no congressional report. There was no analysis. And when you look on the surface at the amendment, it's just a few words long, and it amends an existing statute. So it's been missed.
Abraham, is what needs to happen is just a new division needs to be created that can regulate cryptocurrencies and consider it just a new asset class that is not easily applicable with the laws of 50 years ago.
Well, look, I mean, the question of future regulation is a deep one. At this point, the urgency is realizing what this does, because this really does raise some very deep questions about the peer-to-peer nature of digital assets, to use the term used in these new laws. And those questions definitely do require debate. As for a solution, let's wait until we understand the problem first. This statute imposes serious new burdens on people who would use digital assets. And it's really important to note how it does this and how the exemptions work, right? So anytime a business, and that can be an individual, as long as you're, depending on the nature of your activity, receives digital assets over $10,000, and remember, receipt in this point is not necessarily a payment. It has nothing to do with taxable income or revenue. It's simply a receipt. And in the physical world of cash, that's pretty straightforward, right? You've got this bulky physical cash. You know if you've got it in your hands. But with digital assets, presumably it means anytime some tokens end up in an account to which you have access, and that may not involve a payment of any kind. And it gives rise to this obligation to not only collect, but also verify the identity, social security number, occupation under current regulations, and a description of the transaction, and to submit that to the IRS within 15 days. And the implications for that are very serious in terms of both the privacy of both parties. But here's the kicker. The exception is when that transaction is already being reported by a financial institution. So the effect of this is very directly to encourage these transactions to flow through banks and other legacy financial institutions or other heavily regulated financial institutions.
Abraham, one last question before you go. You have a unique experience of being obviously very knowledgeable about crypto, but also having experience in Afghanistan. And I was just wondering if you just had any thoughts on, are there any use cases for crypto in the current situation in Afghanistan?
Wow. Well, this is a difficult question. I spent time there, and I'm dealing very personally with the plight of many over there, and that's certainly something I'm starting to look into. There's a very difficult situation on the ground with the collapse of the financial infrastructure there, and I think the answer to that could be yes.